All right, welcome back to Talk Tickers. It is Thursday, January 29th, 2026. And looking at the tape, honestly, I think we need to talk about a crime scene.
A crime scene? That's a little dramatic for a Thursday morning, isn't it?
I don't think so. I mean, look at Corning, ticker GLW. They report yesterday. They beat on revenue. They beat on earnings.
Right.
They announced a $6 billion deal with Meta, which is like the holy grail of AI contracts.
The absolute dream contract.
So the stock opens up 16%.
Yeah.
And then just falls off a cliff.
It was a bloodbath by the cliff. You're right. Closed down about 5%. $104 and change. That's a 20% swing.
Intraday.
On a blue chip stock. It just doesn't happen. So that's the mission today. I need you to explain this to me. Is the market seeing something we're not? Or did it just have a complete temper tantrum?
I'm leaning toward tantrum.
Yeah.
But to really get why, you have to look past the red on the screen and actually listen to what management said.
Okay.
Because the story they're telling, it's not about selling glass anymore. It's about becoming a landlord. A landlord. Okay, put a pin in that. I want to get to the landlord thesis because that sounds like a stretch. But first, the actual numbers, the Q4 scorecard.
Right.
If the earnings were bad, this all makes sense. So were they bad?
No, not even close. They were impeccable.
Impeccable. Okay.
Let's just, hit the headlines. Revenue, $4.41 billion for the core business. That's up 14% year over year.
And what was the Frangus Creed expecting?
4.36. So a clean beat on the top line.
All right. So they're selling more stuff. But are they making more money? Because the whole bear case on Corning for years was, volume without value.
That's the story. And that is exactly what they fixed. This is maybe the most important number in the whole print. Core operating margin hit 20.2%.
20%.
Up 170 basis points.
Give me some context on that. Is 20% good for this kind of heavy industrial company?
It's excellent. But the real insight isn't just the number, it's the timing. You remember their big Springboard plan, right?
Yeah, that was the whole multi-year plan to fix profitability.
Exactly. They weren't supposed to hit this margin target until the end of 2026.
They just did it.
They just did it. A full year ahead of schedule. They're basically lapping their own plan.
So the turnaround is actually working faster than they even promised.
Much faster. And you can see it in the cash. Free cash flow for 25 was $1.72 billion.
Wow.
That's almost double what they did in 2023. So, no. The fundamentals are not broken. If anything, the machine is running hotter than it has in a decade.
Okay, so this is a paradox. The machine is printing cash, margins are up, revenue's up, but the stock gets hammered.
Right.
Usually that means guidance was terrible.
No,
Today's warrant for
the exact opposite. They guided Q1 sales to between 4.2 and 4.3 billion. So that implies the 15% growth is going to keep going.
So good past, good future.
Yeah.
This brings me back to the psychology of it. The stock was up 16% before the market even opened.
It's that expectations treadmill. When a stock runs that hard, and remember, it was up big the day before too, good just isn't good enough. It has to be like divinely perfect.
So traders were just looking for an excuse to sell.
I think so. They were taking profits. But here's the thing. If you sold yesterday because you saw the stock dropping, you totally missed the actual story.
The strategy upgrade. This is where the CEO, Wendell Weeks, comes out and says they're going to double the size of the company.
He didn't stutter.
That's such a huge claim. I mean, the company's been around 175 years, and now they're just going to double. It sounds like CEO fluff.
It totally sounds like fluff. I agree. Until you look at the receipts, they officially upgraded their long-term sales target. They're now planning to add $11 billion in new sales by 2028.
$11 billion, that's up from 8. Right?
Up from 8. I mean, $11 billion. That's the size of the Fortune 500 company they're just planning to bolt on.
Okay, but how?
Well, it's not a guess. They upgraded what they call their high confidence plan for 2026. They now see $5.75 billion in confirmed incremental sales.
High confidence. It's just corporate jargon for we have the signed contracts, isn't it?
It is. It means the backlog is real. And the biggest signature on that paper, well, it belongs to Mark Zuckerberg.
The Metaflex, let's unpack that. $6 billion agreement. But these up to deals can be kind of vague. Is this real or is it marketing?
Oh, it's very real. And the structure is, well, this is where we get back to that landlord idea.
Okay.
You have to understand the power dynamic. Meta isn't just going to, Best Buy and picking up spools of fiber optic cable.
Right, they're not wiring their garage.
No, they're building these massive Gen AI data centers. And their biggest problem is that the specific type of glass they need, this high density stuff, It's incredibly scarce.
So Meta is paying them to be first in line.
They're paying to reserve the factory. They're an anchor customer. It's like prepaying for an apartment in a building that isn't even built yet, just to guarantee you have a place to live.
So it's a capacity reservation.
That's the perfect way to think of it. Meta can't afford to have $1 billion of GPUs sitting there with no way to connect them. So they're writing a massive check to make sure the glass plumbing is waiting for them.
That completely flips the script. Usually the supplier is begging for orders.
It's a total power reversal. And did you catch the wording they used on the call? They said they are in the process of concluding several additional agreements of similar size and scale.
I did catch that. Several. And similar size. So if the Meta deal is $6 billion?
You do the math. If you get 2 more of those, you're looking at another 12, maybe $18 billion in potential backlog from just the hyperscalers.
So Amazon, Microsoft, Google, they're all lining up behind Meta.
It's a land grab for optical interconnects.
But why is this happening now? We've had data centers forever. Why is the glass suddenly the bottleneck? Why not just use normal internet fiber?
This is the key technical point. You have to understand the difference between generic fiber and AI fiber.
Okay, explain it like I'm 5.
All right. The fiber that connects your house to the internet is a commodity. It's meant to run in a straight line for miles. The world is swimming in that stuff.
Okay.
But inside an AI data center, you're connecting thousands of GPUs that are inches apart. You have to pack thousands of strands of glass into a cable the size of your thumb.
It's a density problem.
An extreme density problem. And it has to be bendable. You're routing these things through tight server racks. If you bend normal glass too much,
The signal breaks.
light literally leaks out. Think of it like a kink in a garden hose. The flow stops. Corning has this proprietary process that lets them make glass that can handle tight bends without losing the signal. That is their moat.
And there's a shortage of that specific kind of glass.
Exactly. Management was blunt. They said, if we could make more, we could sell more. They are completely sold out.
Which brings us back to the Springboard plan.
Right.
They're making customers pay for the new factories.
And that's the landlord model. The old way, Corning would build a factory, take on all the risk, and just hope customers showed up. Now they're saying, you want the glass, you pay for the factory first.
Which completely de-risks the capital expenditure, the CapEx.
Totally. And that's really important because the CapEx is going up. They're planning to spend about $1.7 billion in 2026. That is a big number.
Right. Capital intensive is usually a dirty word on Wall Street.
For sure. But in this case, a huge chunk of that capital is already pre-funded or guaranteed by these long-term contracts. It's not speculative spending. It's what they call revenue assurance.
Okay, so let's play devil's advocate. If it's also guaranteed, why the sell-off? Is there a fundamental bear case here beyond just, profit taking?
Well, that $1.7 billion CapEx number is high. If you're a really conservative investor, you might worry they're overbuilding. What if the AI bubble bursts?
That's the ultimate risk, right? What if Meta just stops building data centers next year?
Then Corning is left with a lot of very expensive, very empty factories. The contracts help, but a collapse is a collapse. The other sort of smaller drag is the solar business.
Hemlock unit.
Yeah, they're ramping up capacity for polysilicon for solar panels, and it's going to drag on earnings by about 3 to 5 cents a share in Q1. It's temporary, but the market was looking for absolute perfection.
So a temporary solar speed bump and a long-term worry about an AI winter.
Exactly. Plus, you can't forget the boring old part of the business.
The TV glass. The display segment.
It seems ancient now, but it is the engine room. Display generated almost $1 billion in net income last year, $993 million.
$1 billion in profit just from TVs.
And the margins are holding at 27%. The reason that matters is that display prints the cash that funds the optical growth. It's a beautiful system.
And they've got the yen risk hedged out, right?
Hedged all the way through 2030. They took that entire risk off the table.
Okay, I want to go back to something technical you touched on. Scale up versus scale out. We hear those terms a lot. How does Corning fit in?
So this is kind of the next frontier for them. Scale out is what they're doing now, connecting racks of servers to each other with glass. Scale up is what happens inside the server, connecting one GPU directly to another.
And that's all done with copper right now, isn't it? Like NVIDIA's NVLink.
Mostly copper. But copper gets really hot and it's heavy, and as you push more and more data through it, the signal degrades really quickly over distance.
So as chips get faster, The copper wire becomes the bottleneck.
Precisely. You hit a physical limit. You can't push enough electrons through to wire. So Corning is betting that eventually you have to switch from electrons in copper to photons in glass, even for those tiny connections.
Because light is just way more efficient.
3 times more power efficient, generates less heat. Now, management was pretty conservative on the timing for this. They said it's mostly a post-2028 thing. But the fact that they're already sold out tells me the industry wants to move faster.
So if that happens, their market just explodes. They go from connecting the buildings to connecting the actual chips.
That's the blue sky. That's when doubling the company starts to sound, maybe a little conservative.
Before we get to the trade idea, there was that human moment on the call. Ann Nicholson retiring.
Yeah, the head of investor relations after 40 years.
40 years. And Wendell Weeks said she was his supervisor 39 years ago.
It was a real Corning blue moment, as they'd say. But it's more than just sentimental. I actually think it matters for investors.
How so?
Well, look at the rest of tech. The average tenure is what, 2-3 years? People are constantly jumping ship. At Corning, the team executing this massive pivot has been working together since the 80s.
That's a good point.
That institutional memory is a huge advantage. They've seen capital cycles before. They lived through the dot-com bust. They know how to manage this.
They're not tourists in the fiber cycle.
Not at all.
All right, let's do it. It is time for our This Is Not Financial Advice segment.
The part where the lawyer starts sweating.
Indeed. This is where we take all the data and just pitch a wild hypothesis. You've called this one the glass fortress arbitrage. Walk me through it.
Okay, the thesis is simple. We're betting that Corning is transforming effectively into a data center REIT.
A real estate investment trust.
But for the plumbing inside the walls, they're getting rent through prepayments from long-term tenants like Meta. So the trade is, you go long GLW.
Long, the landlord of photons. I like it. What's the short? What's the other side of the trade?
You short the old world, you short generic copper cabling companies, and maybe more interestingly, legacy commercial real estate.
So you're shorting the empty office tower, going long the AI factory.
Exactly. The modern office building is empty. The modern factory, the data center, is full. And the plumbing in that new factory isn't copper. It's high-density glass from Corning.
You're playing the great divergence.
You are. And you're buying the dip on this sell-off. You look at that drop yesterday down to 104 and you say, thank you, Mr. Market, because you're buying the essential infrastructure of AI at a discount.
What's the biggest risk to the trade?
The risk is that the scaling laws for AI break. If GPT-5 comes out and it's not much better than GPT-4, the hyperscalers might pull back on spending. And then the landlord is stuck with a bunch of empty glass pipes.
Glass shatters.
It does. But right now, the checks are clearing. And one more thing on the long side, the buybacks.
Oh, right. They're buying back their own stock.
Resumed in Q2 of last year. So while you're waiting for this whole AI story to play out, the company is actively shrinking the share count underneath you.
It's a nice little safety net.
Okay.
Let's wrap this up. Give me the key takeaways.
Point 1. Corning crushed the quarter. The business is fundamentally very, very healthy.
Point 2. The strategy is shifting. This is a growth story now, with a high-confidence plan to add billions in new sales.
Point 3. The Meta deal is the signal, not the whole story. It's the first domino in a massive hyperscaler build-out, and Corning is becoming the landlord.
And point 4.
The sell-off was noise. The stock got ahead of itself. The drop is an opportunity because the bottleneck in AI is manufacturing, not demand.
The bottleneck is manufacturing, not demand. I like that.
That's
the key.
That's the tweet.
Check the numbers, ignore the noise. This is the deep dive on Corning.
Catch you on the next print.
And as always, this is not financial advice. Please do your own research. We'll see you next time.